I think the first question you need to ask yourself is what kind of funding you want. VC is what you read about, right? And so people assume that they need venture capital, but there's lots of other options. I've bootstrapped a number of companies, also taken money. That is an important first question that most people skip right over. But if you find yourself in the bucket of saying, well, look, this is a real high growth opportunity. I have some real costs that I need to incur to exploit that opportunity. Therefore, venture is a really good fit. I think what you want to ask yourself is what expertise does that investor bring or that firm bring that I don't currently have on my team?
Latest episode of Raise&Exit podcast, this time the rainy version, as you might see in the background. Today, we have Matt McDonnell, and he's going to be sharing with us from multiple perspectives, not just as a VC from Stellifi, but also as a fellow podcast host who has some interesting insight and experience to hand off over to you. And he is very much in the theme of why Raise&Exit exists. So on that note, Matt, please tell us a bit more about yourself. Please tell us about your podcast and your philosophy of value transfer that you pursue, and then we'll dive right into the thick of things.
Yeah, thanks, Edgar. Appreciate you having me. So yeah, my name's Matt McDonnell. I'm a real estate developer and venture capitalist in real estate. So I've been working in both of those industries simultaneously for about the last 10 years. And so, for me, we were having a discussion prior to this where, you mentioned something that was really near and dear to my heart, which is that the best way to learn is from other people's mistakes, not from your own. And so the podcast that you mentioned is called Navigating Complexity, where I interview successful friends and colleagues of mine and really kind of dive deep into the details of why they made the decisions that they did to help illuminate, what I think oftentimes from the outside looks like a pretty linear career path, but in reality, when you really look under the hood, is anything but. And so getting their insights, failures, and learnings in hindsight is really what we're trying to accomplish on Navigating Complexity.
Matt, I love that, the fact that you're doing that, but I also want to kind of add to this, which is I think one of the paradoxes of being a founder or business owner or an entrepreneur, which is a lot of the kind of coverage that we get is heavily hyped towards like the really crazy positive stories or the cataclysms. But the reality is there's millions of entrepreneurs that start companies every single year, and we don't really talk about, call it the middle 99%, right? So I'd love to kind of get a sense from you, Matt, like what's from your experience that you've had working with companies, seeing that peer network that you're interviewing become successful, right? Would you give as a guidance to founders, entrepreneurs, and business owners on how to shield themselves from the noise of the hype or the horrible outcomes?
Yeah, it's a great question. So, I think for me, at least what I've observed and experienced myself is that success usually exists at the intersection of curiosity and a very steep learning curve. So, there's sort of this knife edge balance, right? Where you have to be doing things that you're not sure you're going to succeed at, but you're doing them because you find value in and of itself to pursue that activity. And so what I think you see is, what people may mistake as blueprints or recipes for success. So you have to work 120 hours a week, you have to drop out of college, you have to start your company out of your garage, right? And those are examples of stories, and that tends to be this archetype that gets played up a lot. But really what those folks were doing is they were deeply curious about something, and they were willing to do something that they weren't sure they were going to succeed at. And I think that brings out the best in people, right? And is sort of a good recipe for success. And I think you see the corollary with the horror stories that you hear, right?
Yeah.
Frauds or what have you. There's a million different examples, but they're just two archetypes, right? But like you said, there's sort of this messy middle or 99% looks very different than those two archetypes. And what I've been able to discern is that, that through line really is, follow your curiosity. You'll be no good if you're not deeply engaged in something, and that to bring the best out of yourself, which is really, I think, another good definition of entrepreneurship, right? It's this engaging in a process of continual growth where you're not really sure what the outcome is going to be. And so in order to do those two things, I find that those are almost universally true amongst all of those other 99% of entrepreneurs, even though, maybe their individual story or archetype or, what have you that they're following is.
I just love that intersection statement that you're going and making as well, because one of the things that I notice is that we also have the problem of the venture capital and the private equity community almost being sensationalized themselves. And I think there's too many people looking for the big shiny object or the big shiny ego trip. So as somebody who I would say, Matt, does not come across as that to me.
Thank you. I hope not.
How would you give guidance to founders that are looking for money with the thousands of venture capital funds that are there at various different stages, let alone the angel network, which is in the tens of thousands? How does a founder know, or what should they be asking themselves or the people that they're seeking for funding to know that this is actually not just a financial fit, but also a philosophical and governance fit? Because I don't hear enough of that. I'd love your perspective on that.
Yeah. Really good point. So, I think the first question you need to ask yourself is what kind of funding you want. I think that you see founders oftentimes just, VC is what you read about, right? And so people assume that they need venture capital, but there's lots of other options. And, I've bootstrapped a number of companies. I've also taken money. And so I think that, that is an important first question that most people skip right over. But if you find yourself in the bucket of saying, well, look, this is a real high growth opportunity. I have some real costs that I need to incur to exploit that opportunity. And therefore, venture is a really good fit. Then I think what you want to ask yourself is what expertise does that investor bring or that firm bring that I don't currently have on my team? And I think that that's a really important piece. So the way that I've sort of lived that myself is that as a real estate developer who is also a venture capitalist looking at the venture ecosystem, I know that I can be really helpful with helping founders understand how real estate owners and operators think, because it's how I think, right? I can't help but think that way. And then also go to market, right? At the end of the day, building any business, however you capitalize it, is about serving customers. And so if you're not able to get those customers, and I don't just mean in a product market fit, right? But really understanding what the psychology is of those buyers, what problems they're really trying to solve that maybe your solution can be a part of. If you don't have that kind of right match with your investor who's going to take a board seat, right? They're going to be involved in governance. They're going to be the first call that you make. You're going to text them at, 10:30 at night when you get an email that a customer is firing you, right? You want that person to be prepared to handle the type of problems that you think you're most likely to encounter, which certainly are go-to-market problems, but I think also are, industry specific. And so having that expertise, and that's not a knock on generalists in any way, shape, or form. They can be very, very helpful in those same things, but I think it is a match, and it's also a marriage, right? And so I think you mentioned the personality side of things. And so, if you find yourself like getting a call from that person and dreading picking it up, right, that's a pretty good signal that, maybe you don't want to engage in a 10 or 12-year marriage with an investor who would potentially provide you capital. And then there's some softer stuff too that you want to evaluate. Like, I think Stellifi very much is not a traditional VC. We're very driven by traction and revenue, not, as a seed stage investor, right? We're generally not investing on a big idea, even when we do seed stage deals, right? Because really my core belief is when you have a product or service that's valuable and you can develop a toehold with a customer, you have a million opportunities to expand that business and to build that big vision. But your first order of business is to get to your next round of funding if you choose to go through that VC route and to survive long enough to find product market fit. And so, if you're of that similar mindset, right, then you want a VC who is going to help you approach it that way and not say, hey, all we need is eyeballs, right? Or all we need is attention, and you want to grow as quickly as possible and, forget about the associated costs, which there's a time and a place for that. It's probably in consumer products, right? Not B2B sales to real estate owners. And so you really do want to match your sort of own approach and outlook to your VC within reason, right? right? And I think that's the other thing is that it is a two-way street learning relationship. And so also don't want somebody who looks at the world in the exact same way you do, right? I think that's dangerous. And so, being able to sort of a platitude, right? But being able to fight well, or being able to argue and have genuine differences of opinion generally will produce better answers, right? So you want to be sort of aligned enough, but not so aligned that you're depriving yourself of good alternatives.
Oh man, there's so many things in that just like this monologue that you just went there, Matt, that I want to unpack. So anyway, it was just really, really like I just had a holy shit moment, which is like, wait a second, like you could be in the business of like making widgets, but if you're going to go down the path of I want to make widgets, but I want to go and get venture capital, you're actually changing your business model. And what I'm just having as a takeaway from what you're saying is there's a core of what you're building as a company, right? The customer side, that's another thing as well. I'm going to go back to in a moment. But on that piece of you're actually in a different type of business model based on how you capitalize the business.
That's right.
And I think the way that you just articulated that, I think is really, really important, that I think as businesses, you have to figure out whether you're going to go and do that, right? Like, look, there's a whole business strategy around for larger companies where we're going to grow inorganically by acquiring businesses, leveraging our distribution and customer base, and we're going to scale them that way. We're not even going to invest as much into R&D. We're not going to invest as much into other things, etc. But I think what you said there is I don't think enough founders actually go and consider that they will need to run their businesses differently based on the route that they're going and taking to capitalize the business.
Yeah.
Because if you are going through VC, you're right. Your business model, yes, you might have a 10 to 12 year exit like expectation, but you're actually running the business in those sprints. And they have minimum thresholds of success for you to be able to go and qualify for the next raise. And I don't know if enough founders are actually thinking about that in their kind of development or articulation of even going to investors with that knowledge of, and I got to probably do this again 3 to 4 times before we go and have the wealth event for us collectively. So anything you want to add on that portion around the funding, adjusting your business model?
Yeah, I think that one of the interesting asymmetries that you see there is that you can build a really good business and then go raise venture capital, right? Mm-hmm. And that happens with some regularity, right? People find, I've got this huge opportunity in front of me. But what is less easy to navigate is to go and build a venture-backed business and then deviate away from that strategy. And so, I think Jeff Bezos has this great, analogy of one-way doors, right? And he always takes longer to consider decisions that are one-way doors that you can't go back through. And I think taking venture capital is one of those one-way doors, right? If you choose to, one thing that I think is worth thinking about is, well, when should you do it? And maybe you don't take pre-seed money. Maybe you bootstrap the business and, you just work at finding product market fit and the solution that the market that you want to serve needs. Then venture's always there, right? Venture investors are always going to invest in high growth opportunities that they see. But if you took that pre-seed money, right, well, then you're sort of committed to that path. And so I think it's always helpful to, at least in my mind, to raise money as late as you can, given the opportunity that you're pursuing. And the more you know, right, the better you're going to do to find the right investor, to raise the right amount of capital, and to have a more fleshed out strategy that you want to execute with those additional resources.
Oh, I love what you said there, because I think there's almost like a signal to listen for or explore, which is, man, I wish you had come to me even earlier to get funding, right? Because people can see that you've already priced in the premium of demonstrating success. And you went and talked about product market fit, which for me is like, it's almost like a jarring statement, because I hate the abstraction of product market fit. Like, I understand why it's used as a shorthand, but what I'm also terrified is when people only use it as it is without forgetting what it's supposed to mean, which is you have a collection of customers that are willing to pay to solve those problems or fulfill those wants, and they're giving that money to you.
Yeah.
Right.
If you found product market fit is you're getting revenue, right?
Exactly. And I think I'm worried about the fact that we've reached the stage where I would even say this is an assertion, I hope it's for the minority of the venture capital community, where they've lost the purpose of the business is to go and find and serve a customer, right? Like product market fit as an abstraction to me terrifies me when it's the only thing that's being used, because I always go and look at due diligence, like what are customers going and saying about your products? Like, are people giving you testimonials? Are you getting referrals? Are people sending you emails? And if they're not, why? Why are they being so passive about it? Or is it that you've specifically engineered a product that is so stupidly simple and satisfying that their inaction is a testament to the fact that they just keep, giving you a charge on their credit card or paying their invoice every month? You see where I'm going with this, Matt? So it's the human side that I think is there. So how do you bring that customer side in? Because I love what you went and said there earlier. How do you weave that into due diligence as you're looking to make an investment? Or what would you recommend that people seeking capital weave into their own due diligence to make sure that they actually have venture capitalists that understand that they're in the business of acquiring and retaining customers?
I think what I said before is certainly true, that if you have revenue and you have net customer retention that's very positive, right, then you have some sort of semblance that you found product market fit. I think another way is it's sort of like the Supreme Court's definition of pornography, right? You know when you see it, and none of these runaway growth stories that you hear about where people are raising a round of venture capital every 13 to 18 months, the feeling inside those businesses is, oh my God, we have so many opportunities to generate revenue, to expand accounts with existing customers, to acquire new customers. And so if you're not feeling that, right, then you have more work to do. And so it's a very lived experience where, you can really tell the difference between that level of traction and whether or not you're still looking for it, right? Because you all of a sudden start getting inbound sales calls, right?
Yeah.
You get referrals, you see accounts expanding without, you having to do a whole lot of effort or put a lot of sales effort into it. And those things happen because customers love your product, but really they love your product because you're doing something that allows them to do what they already do better, faster, and cheaper. And so I always use DocuSign as a great example of this, right? Like nobody would put on their list when DocuSign started of biggest problems, signing contracts, right? But it's a problem that every single person has. It's really painful. Nobody liked printing out documents, signing them, and scanning them back. And so it was such a real need that it took off, right? And as soon as somebody heard, I can do this, right? I can execute this agreement that way. Well, then they go out and they find your product, right? And so I think it's sort of the same thing where, if you're wondering if you have product market fit, you probably don't. And, if you do, then you are not triaging problems so much as trying to figure out how to get to opportunities. And so that's really, I think for me, the sort of feeling inside of a business that you should have if you're going to raise venture capital, as opposed to, we're still looking around to try and figure out what to do.
So I want to continue on this theme of kind of call it the biases of the founder or the biases of the investor in this dynamic. Something that I'm finding fascinating is, again, kind of looking at the extremities of the market, right? There's this whole piece of like, oh, you have to be in Silicon Valley, or you have to be in Boston if you're in health tech or something like that. I'd love to kind of get your take as an investor. How much does place matter?
Yeah, it's such a good question. I mean, it is undeniable that certain ecosystems are more helpful to a company flourishing. So I think a good example is, if you want product people, it's probably better to be in the Valley or to be in New York City or to be in Toronto, right, or Austin, some of these places that have established venture ecosystems, because there's just more of that talent available, right? I think one of the other things that I've seen, and I've been surprised by at Stellifi, is that we're geography agnostic, but about 60% of our investments in real estate technology are based in New York City. And I think in hindsight, the reason for that is that New York has had real pressures in the real asset market for a lot longer. There's a ton of finance talent, and there's a ton of people that have an understanding of real estate finance in particular. And so you just tend to see more of those businesses located there, right? Whereas if you look at a Houston or an Austin or a Dallas, sure, lots of those things are also so true. But you can just keep building the city, east, west, north, south, right? And so you haven't run into a lot of the same operational complexity if you've been working in that real estate field, just as a result of geography. So I think it's a little bit different for every business. But I also think that real estate investors, being able to source talent and resources aside, venture investors are willing to overlook geography, right? I think Drive Capital is a great firm that's always been focused on the Midwest, and they've done very well, right? And it's because they've made good decisions. And I don't think you're going to find a lot of VCs in some of these more traditional VC markets that would overlook a company that's got 40% month over month growth just because they happen to be based in a different market than the one that they typically invest in. So I think it's both important and irrelevant, right? Depending on the individual company and what it really needs to grow. I think that's sort of that comment that you made about, the biases that you bring to it, right? Like, I think it's a bad bias to say I will only invest in cities or X, Y, or Z. But at the same time, I've heard this great quote from a couple people that the definition of a good VC is knowing when to break your own rules, right? Because at the end of the day, being right matters a whole lot more than following your own rules. And so, I sort of think about geography that way too. Like, even if absent abandoning your own fund mandates, I think it could be a useful tool to focus your deal flow and where you're sourcing activities. But I think most folks, if you press them right or get them in private, would say, well, sure, but I'm very willing to do X, Y, or Z unless they have a mission that says I only invest in Texas companies, as an example, or Heartland cities.
That's great. I want to kind of finish the last portion of our podcast with each other off of kind of like a catalyst of what you went and said around success as being at the intersection of curiosity and learning. And there's an element here that I'd love to get your perspective on, which is how important is it, and when and to what degree should founders, earlier stage companies invest into what I call knowledge asymmetry, where you know more about the market than your peers or competitors, whether they're other early stage companies or the establishment. I'd love your take on it. I'd love to hear more about this generally in the world, but what does Matt McDonnell have to say?
I think if I put my real estate developer hat on, knowledge asymmetry is how that entire industry works, right? You know that you can get something upzoned. You know that this is an undervalued submarket, right? You know that a new corporate relocation is coming in and the market hasn't really turned to it. And so, there's only 400 apartments to serve 8,000 new workers, right? So I think that's such a fundamental experience that I've had as a real estate investor and developer, that when you think about it in venture, I think it's sort of looking for that analogy, right? And so I think part of that curiosity is what creates that knowledge asymmetry. I was looking at a mortgage origination technology platform, and the fellow who is the founder just knows more about mortgages than anybody else that I've ever met. And so when you think about, and not because he, decided that was his thing, it's because he's actually curious about it, right? It wasn't just some decision made out of the ether. And when he opens up his social media accounts, that's who he's following. That's what he wants to learn about. And so I often think of knowledge asymmetry as a function of that curiosity, right? And that's how you develop it. There's no way to fake it, right? You can't pretend to be interested over the course of 20 years in something you're not actually interested in, right? So I think, and similarly, if you're that founder who does have that deep level of curiosity, the skill set and the person that's going to be great at taking, going from 0 to 1, it has to be a different person to go from your B round to your D round, right? And so that curiosity, or that what I think of as sort of an innate ability to learn, is necessary, because whatever skill sets you have today, you're going to need different ones in the future. And so I think that's sort of how I look for that knowledge asymmetry, is that the market's going to move, particularly in a technology environment, right? The market's going to change, the competitors are going to change, the APIs that you need to consume, the consumer behavior, all of that's going to evolve. And so if that curiosity isn't there, even if you have knowledge asymmetry because you used to work in some big firm and you saw this unique idea that nobody else really had insight into, we've still got to maintain that over time, right? And that is a process and a vocation, not a certificate that you get, right, or a bit of education that you can go consume for tuition dollars.
Do you look for that in deals? Like, do you like explicitly or discreetly look for, is there knowledge asymmetry in the leadership or in the intelligence that the company's using?
Yeah, absolutely. But I think, the word of caution I'd provide is that it cuts both ways, right? So having the knowledge asymmetry is great, but it can also blind you to deeper concerns. So like particularly in real estate tech, there's so many segments, right? You can think about it as construction technology, you can think about it as management software. And so if you're so niche-y and don't understand, you have deep asymmetry, say in horizontal construction, right?
Yeah.
Well, you've done that your entire career. Well, that's great, but you might miss the forest for the trees, right? And so I think that's why that continuous learning ethos is something that might ultimately even be more important. So definitely look for it, but it's a necessary but not a sufficient condition for success in my estimation.
That's really interesting because I love the double-edged sword aspect that you went and put there. Like I actually find like the absence of thinking that way is probably the most dangerous signal. But I also like how you're putting into that you can actually get into the trap of like living into your own biases. So just love that pragmatism on that part of it. I'd love for you just to kind of give a little bit of like, why would somebody want to come to Stellifi at what stage in terms of seeking out either your counsel or a check? So maybe a little bit about Stellifi for folks that are in the real estate or adjacent spaces.
Yeah, so we're primarily a pre-seed and seed stage investor. So our down the fairway strategy is to lead seed rounds, take a board seat, and to do so where we think we can genuinely add value, which I know is a little bit of a throwaway in the VC ecosystem sometimes. But what we really mean is if you need to understand how owners and operators of real assets, in particular multifamily or commercial buildings, think, make decisions, and solve problems, we're probably, should be on the list. There aren't a ton of VCs that are both active real estate investors and active venture capital investors. And I think, it's a hard balance to keep, certainly is time consuming, but I think that being a real estate investor makes us a better real estate tech VC or sponsor, and being a tech VC certainly makes me a better real estate owner and operator because I'm using a lot of the solutions, whether we've invested or not, there. And then the other thing that you hear a lot about with VCs is, well, we have this network, right? And so I think the question that, like we talked about before, that you should ask yourself is, well, is that network what I really need, right? And so if the thing you need is access to, X, Y, or Z firm, and we don't have that, that's probably not a great fit. But what we do know is we do know all of the owners, operators, institutional lenders, JV equity groups, right, that are active in that real estate space, construction firms, construction management firms, property management companies. And so if what you really need is somebody with industry expertise and relationships that are deep in that industry, then, we probably would be good to put on the list amongst, probably a dozen other firms that I can think of that I think do a pretty good job there as well.
I love that kind of like at a certain point, you got to go hyper deep in a vertical to really be able to credibly succeed in it. I've seen the same thing in places like logistics, in blockchain, and other domains as well. Matt, it's been such a pleasure to have you share your wisdom. Go and check out and get more of Matt's wisdom through his podcast, Navigating Complexity, as well. And thank you for joining us today.
Yeah, thanks so much for having me. I really enjoyed it.
Awesome.